Let me ask you a question. Have you ever entered into a trend only to see it reverse against you, causing you to eat a losing trade? Or perhaps the market is rallying and so you decide to sell because you think the market can't rally any further, but it does, and it causes you to miss out on additional profits. Today we're going to take a look at an indicator called VWAP. We're going to cover what VWAP is, how to use it in a trading strategy, and what settings are most useful when applying it to your charts. VWAP is a single line that appears on the chart, and it stands for volume weighted average price. Here we take a look at a chart, and the VWAP line is the yellow line running through the middle. If the market is moving too far above the yellow line, then it is considered to be expensive and prices may retreat back towards the line. If the price is significantly below the yellow line, then it is considered to be cheap and then may rally back towards the line. In a few moments, we're going to explain how this average price is considered to be better than some other average prices and tools that may be out there. But for the moment, consider that it's just not as simple as if price is too far away from the line, it's expensive, and too far below the line, it's cheap. Because if you consider back in the 1990s and the internet bubble, the valuations of the internet stocks were extremely ridiculously high, and yet the prices of those internet stocks that were generating no earnings kept rallying. So they were expensive and they kept getting more expensive. Likewise, have you ever bought a stock or bought into a market that was cheap only to find it getting cheaper? So there's something else that we need to bring to this formula and bring to this tool to help us understand when might be a time to consider buying and when might be a time to consider selling. Let's get to using it. So remember, when we take a look at our chart, the VWAP line shows us areas of the fair price. And the farther that prices move above the yellow line, then the market is considered to be getting expensive, and we may see eventually prices revert back to the yellow line. Same way, if prices are below the yellow line, prices eventually will revert back to the fair value, the fair price. So the yellow line can act like a magnet. Now, there's another set of lines we want to add to this chart that will help bring it to life and make it easier to spot and identify some trades. So within the TradingView, I'm going to open up the settings of the VWAP, and I want to add upper band number 1 and lower band number 1. And these bands need to be set on a multiplier of 1 standard deviation. So what this does is it produces 2 lines on the chart. This yellow VWAP line is now flanked by an upper line and a lower line. These lines are deviation bands. They're a standard deviation from the yellow line, the VWAP line. The deviation bands are a reflection of the VWAP line. So how volume is calculated inside the VWAP line, that volume of prices is also going to be included within these bands as well. So the bands also receive the benefit of the volume weighted average price in the VWAP. When we apply these to our charts, there's essentially 3 benefits. First, the VWAP helps us identify the direction of the trend. As the lines are pointed upward, it tells us that it's an uptrend. As the VWAP line is pointed downward, it indicates to us that it's in a downtrend. So when it's moving up or down, it indicates to us that it's in a trend and it's being supported by volume. Second, we can use the bands to help identify levels of support and resistance depending upon the trend that we see in the market. So in an instance where the market is in an uptrend like what we see here, well, this upper band acts like support so that any dip from a rally tends to find support at this upper band. And when the rally's over, you'll notice that it begins to push through that upper band. Which then leads us to the third thing. The VWAP line, the yellow line in this instance, is that fair price. And so this is where the institutions like to transact. And any deviation or significant deviation from this yellow line is going to act like a magnet and draw prices back towards that yellow line. So we're going to use this yellow line as a take profit level because it'll be that magnet and that attraction for prices. VWAP can be used on any charting time frame, any style of trading. It is versatile with regards to day trading. You can use it in swing trading or even longer term trading. There's two different ways that we can incorporate a strategy around VWAP. So here we're taking a look at a 1 hour chart, and I've got the VWAP set on a weekly session. What that means is that the anchor period is set to week. So every Sunday afternoon, the slate gets wiped clean and then it starts recalculating the volume again. And so that's why you'll see significant changes or drops or sharp movements within the VWAP line where the bands collapse. The calculation is going out and it's resetting itself. In this case, we're using an anchor period for a week. So every Sunday is when this is going to reset. If you're going to use a daily session, every 24 hours it will reset. If you use a monthly session, the calculation is going to reset every month. So I've got this set on a week session. There's two different ways that we could trade according to this. First is you want to take note of the direction that VWAP is moving. So for example, most of the chart that is on my screen, the VWAP line is moving sideways, and we also have the bands moving sideways as well. And so this is very simple. What you want to do is you want to buy at the lower band or short at the upper bands. Now, when you buy at the lower band, you're going to look to take profit at the yellow line. So you're not going from one band to the other. You're basically buying the lower band, taking profit in the middle at the VWAP line. You would short at the upper band, and then you would take profit at the VWAP line. And you'll notice that the market is sideways. The market is said to consolidate, move range bound and sideways 80% of the time. So this is probably one of the more common type of strategies that you're going to see, basically just selling at the highs and buying at the lows, taking profit at the midline. When the VWAP line is moving in a direction, the market is trending, and so therefore the VWAP line is trending as well. In these instances, the upper line is going to act like support for prices, and the lower line is going to act like resistance. So what you would do when you get a directional bias of the VWAP line and of the bands is you would want to buy when it comes back to revisit and retest the upper band. If we take a look here, the market is figuring out what direction that it's wanting to go. It starts to break out higher. So you could use this consolidation back to the band as a means to buy. And then it breaks out further, and then it comes back to the band to consolidate. Now, the trend won't last forever. Eventually it will stop, but you'll know that the trend is over as it starts to pop back inside the band like what we saw here. Now notice it popped back inside the band, went back outside the band, but it never really created another high, never really continued to trend higher. So that's going to be your clue when this trend is ending, and that you might want to start looking for some consolidation trades when it pops back inside the upper band in this instance. So VWAP is so versatile that it could be used on a variety of chart time frames. Let's go out and take a look at the settings real quick and go over what the various time frames are and how you can change them. So first of all, it's the anchor period, which is basically how often the calculation resets. The charts that I've been sharing with you here are on a weekly basis. So what that means is every Sunday, the calculation is going to reset. You're going to see the VWAP drastically change, and you're going to see those bands collapse. You can also change this to a session. Now, what a session means is a 24-hour period. You've also got month. I'm going to leave it on the week session for now. Some people may wonder and even ask the question, is VWAP reliable? I mean, yes, I understand we're incorporating volume into the calculation of the average price, but is it useful? Is it helpful? There are times where you're going to want to be careful about using VWAP, and that is at the beginning of the calculation. So here we're on a weekly session, and what I've marked off here in between these two white lines, this is basically when the calculation restarts, and then it's about 1 day later, so 24 hours later. And basically, if you're using the weekly recalculation setting, you'll want to stay away from using it on the first day. We need to start to see some volume of trades entering into this. And by the time we get to 24 hours later, we're starting to get some of the initial instances of the new trading week, and the trends can begin to emerge if there are any. So stay away from basing any trading signals within the first 24 hours of the first day of the week if you're using the weekly calculation. And then you can see here's the calculation for the rest of the week, and then the recalculation restarts. And so we're going to want to stay away from this 24-hour period. We have some volume entering in, and then we can start to see some signals generate, and then you could use the signals based on it for the rest of the week. Now, if you're going to use it for a session, a day trading session, a 24-hour session, then you're going to want to stay away from the first couple of hours so that it recalculates, volume starts to enter into the calculation, and then a couple hours later you can begin to see what trends, if any, are beginning to exist. There's another tool out there, which is an average price, called the moving average. Moving average basically has two components to it. It has time and it has price, and it's basically averaging all of those together. Well, VWAP, on the other hand, adds a third dimension. Not only is it time and price, but it's also adding the volume of trades that are being traded during each of those segments. And so the more that the market is rallying on rising volume, well, then that will impact the VWAP. Whereas the standard moving average, the volume does not play a part into the calculation at all. I've got two lines on the chart. The yellow line is the VWAP, and the brown line is a moving average. And you can see coming in here to the left side of the chart, both the moving average and the VWAP line are fairly similar. And this would make sense if there's a sideways trend going on, or really no trend, consolidation, and there's not a lot of volume going into the market, then both the VWAP line and the moving average line are going to be fairly similar to one another. But notice how the VWAP line is essentially moving straight sideways, whereas the moving average line is oscillating up and down a little bit. Now, if we progress a little bit further to the right, you'll notice how the VWAP line does start to take on an upward slope to it. And that upward slope suggests that there is more volume coming into this trend. And so therefore, as a part of that calculation, it's pushing that VWAP line higher. Now, likewise, the moving average has been slow to respond to that trend because it's still back here calculating the previous session's data where there was not a lot of volume, and that is holding down that average price. Without that little volume, it's playing very little into the VWAP calculation. We get the rally, and then prices start to reverse. Now, notice that as the price reverses lower, notice how this VWAP line starts from sloping upward to sloping downward. And so that suggests that there is some volume within this particular downtrend. And then eventually the VWAP line ends up going sideways, suggesting that it's a consolidation. There's not a lot of volume going in behind these trades. Meanwhile, the moving average continues to oscillate up and down and move sideways. Now on this next little trend higher, again, VWAP, the line begins to work itself higher, slope higher. There was more volume coming into the market. The moving average line is a little slow to respond at first because that moving average is taking into its calculation some of the old bars where there wasn't a lot of volume. That's going to weigh heavier in that moving average. It's going to weigh very little within the VWAP. And so VWAP takes off right away as soon as volume starts to hit the market. Moving average is slower to respond. And then once the market gets up here towards the high, the volume starts to abate and slow down. VWAP levels off, starts to move sideways. Meanwhile, the moving average continues to work itself higher. So in essence, when the market is in a trend that is supported by a lot of volume, which a lot of times is going to come from your large institutions, the VWAP line is going to be responsive to those trends, and it's going to slope in one direction or the other. But in times where the market is flat and there's not a lot of volume going into it, VWAP is going to move sideways, but your moving average may still oscillate up and down. And so that's the difference you're going to see between the VWAP and the moving average. Some traders may look at the VWAP and the bands associated with it and be like, hey, that looks a lot like Bollinger Bands. Why don't I just add Bollinger Bands to my charts? Well, there are some similarities and there are some major differences between VWAP and Bollinger Bands. So let's go over these similarities and differences right now. Now, if I turn on Bollinger Bands, you'll notice that it is similar. They both have a center line and they're both flanked by outer bands that are a calculation or a derivative of the center line. So any differences that we see in the center line is also going to expand out and affect the bands. So those types of things they have in common, but there are a couple of very important differences. In the case of Bollinger Bands, the center line is a moving average. And we've already gone over what that difference is. A moving average is just an average of price and time. Whereas a VWAP also incorporates volume into that. And so you can then determine if a particular trend is not supported by volume. So that's an important difference. Number one is that center band. The second major difference between Bollinger Bands and VWAP recalculates based on the given time period that you put into it. So again, on my charts, I'm using a weekly recalculation period. The bands and the VWAP are going to continue calculating all week long, and then on Sunday, it's going to restart the calculation over. But with Bollinger Bands, because it is a moving average, that average is moving with every new candle. And so that average is moving along, which is why we get the oscillation up and down with that moving average. But with VWAP, the line moves sideways, the band moves sideways. When the market is trending, then the VWAP line will have a directional bias, and also the bands will have a directional bias as well. As you can see, VWAP is a favorite tool amongst institutions because it incorporates volume in addition to calculating price and time. Now, if you found this video useful and helpful, go ahead, give us a like, subscribe to this channel as we produce more videos on other indicators. Feel free to check out our next video as well, and we'll see you in the next video.